Thank you for joining this Real Estate Digest virtual Nordic update. We look forward to taking you through management's views on their markets and recent results. Unfortunately, due to recent corporate activity, Citycon's Sakari Järvelä is unlikely to be able to join us today. We're nonetheless sure you'll find Kojamo and Wihlborgs updates valuable. Questions can be asked via the Q&A section and will be treated anonymously. So please don't be afraid to ask questions and they'll be sent through. Before I hand over to Paul May, Head of Real Estate Equity Research at Barclays, I wanted to briefly mention the EPRA Corporate Access event in London on Thursday, the 6th of June. There'll be over 20 companies available for one-on-one and group meetings, and you will be sent registration details in the coming weeks. We look forward to seeing you there. Without further ado now, I'll hand over to Paul, who will take us through the webinar and close the event. Thank you, Paul.
Thank you, Matt, and welcome everyone to the EPRA Virtual Nordic Update. I'm Paul May, Head of Real Estate Equity Research at Barclays, and I'll be your host for the next 1 to 1.5 hours. I'm joined by Jani, Nieminen and Erik Hjelt from Kojamo, and Ulrika, Hallengren and Arvid, Liepe from Wihlborgs. As usual, each company will give a 5 to 10 minute presentation, followed by our Q&A session. As Matt mentioned, questions can be sent in via the text chat in the Zoom function. But without me carrying on at the moment, I'll pass over to Jani and Erik to kick off from Kojamo. Over to you guys.
Thank you, Paul. Jani Nieminen here. Hi. Happy to provide some color on Kojamo, which is a leading real estate investment company for residential business here in Finland. Our operations are focused in the biggest city regions, and our approach is such that we provide added value for our customers by combining apartments, common spaces, services, both physical and digital. And assets today, 8 billion euros and LTV 40.6. So the balance sheet is quite strong at the moment. Then moving a bit further on the next slide, it's important that we do have mega trends creating long-term demand for new rental apartments throughout the country. Even though the country has been known as owner-occupied country, so if you look at the national figures, most often you hear that more than 60% of Finnish people live in owner-occupied apartments, but actually in the biggest cities, the story is totally different. In the 3 biggest cities, Helsinki, Turku and Tampere, today more households live in rental apartments than in owner-occupied apartments, and the portion of households living in rental apartments seems to be increasing on an annual basis. So whenever we get new data, the portion of people living in rental apartments is increasing. What's creating that impact is, of course, a couple of facts. One is that we still have an increasing number of small households, and typically 1 and 2 person households choose rental apartments instead of buying the apartment. If you stay a bit on the last page, please. So don't change yet. And the other thing has been that now as housing prices have been increasing and people's values toward ownership have been changing, we get actually more and more tenants who could actually buy the apartment but are choosing not to take a housing loan and are deciding to rent the apartment. At the same time, population growth in the biggest cities is robust. Finland's been lagging a bit behind the rest of the Europe concerning urbanization. So that creates the population growth here in Finland. At the same time, we did have a high volume of new residential startups during the last 5 years, but now since the last 18 months, the number of new residential startups has been historically low, and now we are moving to an era where we have a very, very limited number of new completions coming to the market. So now looking forward, the demand supply balance will actually change radically, and existing supply will be absorbed from the market during the latter part of this year and then 2025. Then moving forward, a couple of words concerning our portfolio, meaning the customers, and happy to say that in the market, typically 3 out of 4 customers are looking for either a studio or one-bedroom apartment, and that seems to be matching our portfolio really nicely. On the other hand, our customers are diversified between different age groups quite nicely. More than 70%, actually 73% are so-called working people. I mean, people between 26 to 64 years. And the youngest customer segment, typically students below 25, is roughly 10% in our portfolio. Then moving forward, a couple of words concerning our financial figures from last year. We did have a solid year. We were able to increase the total revenue by 7%. That was a combination of completed apartments to the market. We completed last year 1,450 apartments. Then we were able to increase the rents and improve the occupancy. And then there was any impact of portfolio acquisition done 2022. Net rental income improved by 6.1%, of course helped by the total revenue growth. On the other hand, yes, the portfolio was bigger and the winter was quite hard, so the maintenance expenses grew by 30 million euros last year. Then FFO improvement was 4.1%. That's a combination of improvement in net rental income, and we did a tender process last year. I think there's worth mentioning the gross investments last year, 190 million euros, basically mostly new development projects, which were 160 million euros. We haven't been starting new development projects for 18 months already, and today we are not starting any new investments. So basically this year we are still completing 2 projects, and that's it. Then moving forward to the next slide. Valuation has been always a topic during the last couple of years. Now it's good to know that our valuation yield at the moment is 4.4%, and during the last 15 months, valuation yield has come up by 80 bips. So I would say the yield impact has been totaling 1.5 billion euros. At the same time, at the end of last year, there was changes throughout all the parameters, and there were some positive impacts as well. There has been an improvement in the net rental income, and on the other hand, the rental growth assumptions have been checked. Here in Finland, we don't have any rent regulation or rent control system in place, and as we see that the balance between supply and demand will change, now the estimate for the next 10 years rental increases in the valuation is 2.6%. I do expect that for the couple of coming years, we will see higher rental increases, maybe double the rental increases, but in the valuation, the expectation or the parameter is for the next 10 years. And lastly, a couple of words concerning financing. Happy to say that our balance sheet is strong and our financial figures are good. Hedging ratio is still 93%, which has been helping us a lot. We've been quite consistent in keeping the hedging ratio high. And that means that at the year end, our average interest rate was 2.4%, including the cost of derivatives. And today, basically all the 2024 and half of the 2025 maturing loans are covered. That's Kojamo story in a nutshell. Thank you.
Thank you, Jani. I'll pass over to, I think, Sakari. Have you just joined? I appreciate you're fairly time constrained, so I'm not sure if you wanted to cover your presentation now, if that's possible.
Yeah, I can do that. Firstly, apologies to everyone for a very brief participation. I think the underlying reason is, in my view, positive, which is we launched a bond issue this morning, and I'm just in the middle of a roadshow, so I will be doing that most of the day. But if I start very briefly about Citycon, if you can flick to next slide, we are operator of shopping centers in the Nordics and Baltics. So we have 3 main countries, which is Finland, Sweden, and Norway. We have also 2 centers in Estonia, in Tallinn, and 2 centers in Copenhagen, in Denmark. Overall 33 centers. Asset value is roughly 4 billion. We currently in the tenant mix heavily weighted towards groceries, which 5 out of 10 of our top tenants are, and we also let me just see what we have in the presentation. Yes, we have about 1.1 million square meters of GLA. We currently BBB minus rated. And maybe I move to the next slide quickly. I think here this underlines this story. So we have shopping centers in prime cities and prime locations in a very much a necessity-based retail setting. So we do not operate luxury malls as such, but we focus on urban hubs that provide services and retail for everyday use. And that's very, very important, given that it gives stability to the cash flows that we're able to generate. So we have a lot of services, a lot of groceries, and a lot of sort of everyday retail. The main driver of our growth last year has been indexation. So about 93% of our rents are index linked. That has been well suited to the inflationary environment over the last years. We're 96% occupied, and rental collection rate last year was 99%, so almost 100. I mean, quickly on the balance sheet, there's been a lot of happening. Obviously, we've been BBB minus rated with stable outlook. We look very much to keep it that way. So we issued equity 50 million last week in an ABB just to underline our commitment to keep the rating after the valuation hit we took in Q4, and also announcing acquisition of our previous JV in Kista in Sweden. And as said, today we in the market for a 300 million euro bond to refinance our maturity in October, which is now short term. Maybe I stop there in the interest of time.
Thank you, Sakari, for making the time, and good luck with the bond issue and the roadshow. Just moving over to Ulrika and Arvid from Wihlborgs. If you wanted to go ahead with your presentation, thank you.
Okay, thank you. So let's start with an overlook of our 4 cities, Malmö, Helsingborg, Lund, and Copenhagen. We have chosen commercial real estates in the Öresund region. In total, 4.4 billion rental value, 2.2 million square meters, and over 2,000 different companies as tenants in this region. This is the largest labor market in the Nordics, connecting Sweden and Denmark in an interesting way. And we can take advantage of high education and a quite young population, especially on the Swedish side, and a need of new people also working in the Danish side. So a nice collaboration between the needs in the Swedish and the Danish part of the region. We have a market value of 56 billion Swedish krona, increased the rental income by 16% in 2023, increased operating surplus by 19%. We are not all over this region. Instead, we have chosen to work in close clusters. It's important for us to have a large portfolio in the same area so that we can help our customers with their growth and their changing needs. Also, these 4 cities, they are connected to each other, but they are still different so that they can create their own identity, and that's important for them to be attractive. Moving to the next slide, we can also see that we over time have been able to increase the value of the portfolio, also during harder times, actually. Even if Wihlborgs celebrate 100 years as a name and a company this year, we compare our business to when we started 2005 and was listed on the stock exchange after the split from Fabege. In 2005, the property value was 7.8 billion, and now it's 56 billion without raising any new capital. So we see that there is a potential in this market. Also, the last period, we have actually been able to have a small growth, even if valuation yields have gone up bit by bit the last 7 quarters. We have invested in our projects and our properties. We have bought some, and we have, of course, signed a lot of new leases, which we also see on the next slide, which is the track record of letting, termination, and net letting. We have 35 quarters in a row with positive net letting, and only 1 quarter on the negative sides the last 16 years. The last years, and not at least in Q4 23, was in very high levels. We signed new leases at a value of 146 million. High level of termination as well, but where there is change in needs, we can meet that need and help our customers to new solutions. We see new demands in many sectors. First of all, there have been a lot of talking about the workplace the last years. We have offices as the main product, but also logistic and production. And we see that when everybody talks about our product, of course, there is business opportunities for us. I would say that this positive new leases and the great volume we see in that, it's a combination of growth. There's new companies, and of course, there's also efficiency improvements. Common is asking for higher quality, better location, and more investments meeting employee needs. Both asking for common areas for meeting and interactivity, but also realizing that employees need areas for quiet and focused work at a part of the day. So moving to the next slide, and over to you, Arvid.
Thank you very much, Ulrika. We were told to keep this very brief, so I love to talk about our balance sheets, but I chose to focus on this slide. The metric net debt in relation to EBITDA, we think describes the financial risk of a company in a very good way. Our net debt to EBITDA has improved over the past few years, as you can see in this graph covering very many years. The ratio now stands at 10.3 times, and we think looking at the balance sheet, it's very important to put the balance sheet in relation to the cash flow that the company actually generates. In that way, we feel that this metric is a lot more relevant than looking, for example, at loan to value, which is, of course, also popular in our industry. Moving to the next slide, we keep focusing on ESG. There are a number of priorities and metrics which we follow up on. The most important ones, which I like to stress, are working continuously with energy efficiency, focusing a lot on our CO2 emissions, looking at scope 1 and scope 2 emissions, the direct impact. We have had an impressive reduction in CO2 emissions in Sweden, measured per square meter during 2023. Possibly even more important, is the scope 3 CO2 emissions, which really is the impact from construction activities. We were one of the first companies completing construction projects for offices and certifying it according to what is called a zero CO2 certification. That was the project Kvartetten in Hjelt on the outskirts of Malmö. We have followed that track, and we were actually the first to receive that certification for a building containing a laboratory with our project Space in Lund, which was completed this fall. And our largest ongoing office construction project, Vista in Malmö, will also be certified in accordance with the zero CO2 certification system. Our ESG activities have received different acknowledgements. According to GRESB, we are a sector leader with 5 stars and a score of 93 out of a possible 100. And according to the Carbon Disclosure Project, we get an A- score and belong to what they define as the leadership group. Moving to the next slide, we have could say a verbal summary of what happened in Q4, the report which was published approximately 2 weeks ago. We have record new lettings, and yet again, we have a positive net letting for the quarter. Rental value continues to increase in line with indexation. We have higher financing costs, but our interest cover ratio still stands at a fairly comfortable 2.8 times. And we have, as I mentioned before, a stable balance sheet to work with. We chose during the previous few years not to make ourselves dependent on the bond market. So we currently have approximately 7% of our financing from the bond market, but it's still important to note that the bond market is recovering, and it's good for us, and it's good for the industry that the bond market works in a reasonable way. Against this backdrop, we continue with our project investments with the ambition to position us for the future. And lastly, the board proposes a dividend of 3.15 kronor per share. And that concludes our presentation.
Thank you very much, Ulrika and Arvid. Now we move to the Q&A section of section of the session. And unfortunately, I think Sakari is unable to stay with us through this, but he may pop in for certain answers. Going through this, plan to cover the macro, operations, cash flows, and financing. I think it's sort of fairly self-explanatory in terms of the running order. But as mentioned at the start, questions can be sent in anonymously through the chat function within Zoom. So please do that if there's any burning questions. Anyone can also ping me on Bloomberg if they would like to as well, if they wanted to ask any questions that way. So moving straight into probably the burning question at the moment, and given the financing environment that we sort of see, there's a lot of focus on the short end of the curve, the sort of base rate cuts coming through within the market, but it's evident that longer dated rates have already fallen and therefore reflect probably the more longer term financing costs that we would probably expect to see. Do you, and probably start with Wihlborgs, start with you, do you believe that the Riksbank rate cuts will have a material impact on either the transaction market or the operating environment for your tenants?
I think that we saw a very important shift in the whole sentiment in the interest rate market sometime end November, beginning December. We were through 18 to 24 months where everybody was just talking about rates going up and nobody knew where it would end. Suddenly the whole sentiment shifted and everybody's talking about rates are going down. How quickly, how much, it still remains to be seen, of course. But and I don't expect the development to be linear in any way. I mean, it's probably going to be a bumpy road, but I agree with the general sentiment that the direction is downwards. Just the fact that this sentiment has changed so much, I would claim, I think that will affect the transaction market a lot, because I think looking at rates moving downwards, irrespective of how soon and how much, I think it will make people dare to conclude transactions in a way which people haven't dared over the past couple of years. So that is, I think that's, I would expect the transaction market to be a lot more active in 2024 than in 2023.
And just following on that, do you think that the base rate has a material factor, or do you think that the fact swap rates and the inverted yield curve that we have is more a focus point for those transactions? So are you already seeing that lowered 5-year swap or the term rates impacting on the transaction market, or are we just too early in the process to see that coming through?
I think that's a bit too early to tell. But I think being a bit repetitive maybe, but I think the important shift is the direction. And if I mean, STIBOR has not come down a lot, but the swap rates have. But I think there's a good chance that the Riksbank will start lowering interest rates during the year, and STIBOR will follow. And so I expect that to materialize, and I think people. I mean, I'm not alone in that opinion, so to speak. So I think people will dare to do things in a way which they didn't 9 months ago.
Yeah. And similarly to you, Jani and Erik, do you see a similar thing with regard to the ECB, or are you, again, it's a positive sentiment shift, but not yet seeing a sort of change in activity?
You are on mute, Jani. Do you want me to take this? Or
no, I started having mute, so I would say that of course this creates positive atmosphere. There's been all the time interest towards the Finnish resi market, but I think it's been a bit bottom fishing, quite opportunistic bids on the table. In my eyes, whether it's acquisitions or investments, we are in turning point, and we need to have a visibility on the new rental levels, rental increases, and then interest rate levels, and you're always able to conduct profitable real estate business, whether the rates are a bit higher or lower, but the equation has to be a new one. But I think it will be a kicker that we will see acquisitions once the interest rate stabilize and come a bit down.
And I suppose, how much of a factor is GDP growth, which obviously in Sweden has been particularly negative, and in Finland I think has just moved quite materially negative. I appreciate it's a bit more volatile. Sticking with you, Jani and Erik, on the first one, do you see GDP slow down, which is probably a bit of a precursor to rates being cut? You know, part of the reason rates are being cut is because of the poor economic activity. Do you see that as being a factor or an issue in terms of your ability to drive that rental growth that you mentioned sort of going forwards, or is there more risk to that rental growth as a result of the slow GDP? I think you might be on mute again. I'm not sure.
And yeah, so the estimate for 2024 is that we would see a turn slightly positive concerning GDP. But I think at the end of the day, if we think about rental increases, they are dependent on the supply-demand balance. And as said, for now 18 months, there has been historically low of resi startups, and we will have only a remaining part of ongoing projects to be completed to the market. And then there's no new supply coming to the market. And at the same time, actually, the population growth in the biggest cities has been high. So that creates pressure for rental increase. And at the end of the day, here in Finland, it's pretty damn cold during the winter. You need a place to be.
And
I think you get fairly cold in Sweden.
Yeah, we have actually used that as an argument also during this time when everybody talked about the death of offices. Nobody should go to work anymore. And we have the same kind of climate also in the southern parts of Sweden. You want to meet people and you prefer to do it inside. So we have also seen, and let's mention something about the growth in GDP or slowdown. Of course, it's important that we have a positive growth overall over time, but let's remember that when we do these measurements, it depends on how you measure and where you measure. If we, for example, look in the southern parts where we have our business, if you look for the whole Skåne, the Skåne region develops approximately like Sweden as average. But if we look in the western parts where Malmö, Lund and Helsingborg is situated, we have a positive net in inhabitants growth and a positive growth also in the business sector. So there is differences, of course, also on a geographical base.
You said, just following on from that, the obviously strong rental increases that we've seen as a result of high inflation, and this is more a sort of question for Wihlborgs, which obviously has the one-to-one relationship with inflation and rent increases. Do you see that as any form of risk that rents have moved above market rents at all, or have you seen a similarly strong progression in market rents over the last couple of years?
Of course, this is a reasonable question to ask yourself all the time. Is indexation and the market rents moving along, or what is the picture of that? And I would say that we have, during many years in the southern parts of Sweden, seen a strong collaboration between building costs and rent levels. So when building costs goes up, also rent levels increase. And that's some kind of a fundament in that. And still the building costs the last years have been higher than the inflation, even though that the inflation the last couple of years has been really high. So what we feel is that the market rents and the inflation has followed well, and we can also see that from how the inflation in the indexation in the rents have been adopted by our customers. But of course, it's important that we as a country get the inflation under control, and so we have a more stability and more prognosable economic situation ahead of us. And of course, let's also remember that the indexation and inflation in Denmark and Sweden are totally different. So for the last years, for example, the indexation in Denmark has been quite low and higher in Sweden. So different markets.
Of course, everybody is better off if GDP is growing, but as Jani already mentioned, for us more important is the supply-demand balance, and that's changing. But there's other topics as well regarding this GDP growth. One is that when there's uncertainties in the market, so home buyers are hesitant to take mortgages and they are not willing to buy homes, and that's something we've seen in Finland already. That actually creates more demand towards rental apartments. Another thing is it's important to keep in mind who are you competing with. So we are not active in social housing here in Finland. So we are targeting those people who can afford to buy apartments, who have their job and who are able to pay the rents. So in that regard as well, the GDP growth is not that negative in Kojamo's type of business.
Yeah, very fair point in terms of looking at the nuances in each of the underlying submarkets and exposures. Just on that, the mention around the rental growth in sort of Horizon region linking up with building cost inflation, is it fair to say you're seeing some, should we say, building cost deflation coming through? Is that a risk on the rental levels at all, or is that not something that you're seeing at all within the market? Just to sort of follow up on that. Thank you.
I wouldn't say that is any kind of a risk for a rental level going down in any way, but of course it's important that we now see a stabilization of the building costs and also a better competition between our contractors. We have a great project volume, and we have been able to continue with our investments in our project also during this period, which, as you also mentioned, the supply market and the competitors out there is important to always have a stabilization, and so the supply and the demand has to follow each other. But we have been able to continue with our investments, and we also see that we have been quite quick during this change, that we can get our calculation sheets together with new expectation on yield levels, and that's a combination, of course, of keeping the costs under control and being helped by a higher rent market level.
And Jani, you mentioned on your side the supply of buildings going down. Is that simply a factor of the build cost, the financing cost, or is there other issues around land availability that are causing that supply to reduce in your markets?
I think there's land available more than we start new project at the moment. In a big picture, that's been a topic typically that whether we have enough land where you are really able to start a building project. But today I would say it's a combination of 3 parameters. One is that construction cost, including the price of the land, has to come down. Second part is how expensive is financing, and the third party is how do you see the rent increase estimates for the future, and we need to find a new balance. But I would say here the rent of the apartment is based on the micro location and the quality of the apartment, and then the supply demand. Of course, typically the better the location, the more expensive is the construction project, but they should be able to create efficiencies and bring down the cost concerning construction process.
And just sort of following up from that, what sort of level of rental increase do you think is needed to make future projects viable again, future developments, to see those increase?
As said, it's a combination of 3 angles. So you cannot take just one angle and decide that's what it's based on. I've been saying that I would be surprised if we don't see throughout the market double or triple rental increases compared to a couple of past years, looking forward for the next 2-3 years. At the same time, building costs should come down 15 to 20%. Then it's a tricky question whether you're willing to start a project with a net initial yield of 4 or 5. It depends on how you see the future.
Yep, that makes a lot of sense. And just within that, if it is a 4 or 5, and let's say based on swap rates, financing cost is somewhere between 4 and 5 as well. Is that still a project you would look to do and fund with financing, or would you need to have a more of an equity sort of funding within that?
I think that's a good question throughout the industry. Is real estate going back to basics, that you really need equity in order to invest? We saw many years where players did a lot of investing without any equity. But I've been involved with this industry since mid-1990s, and it used to be so that in real estate you need equity when you start investing a lot. So I think LTVs cannot be that high as they were for some players, and so you either have to make a balance how much you invest, or then you need equity.
I think that feeds probably quite nicely on, and we can get the sort of views of Arvid and Ulrika on that as well. But also moving on to the financing environment, and obviously as Jani, as you mentioned, that was very available and very cheap for many years, and we've seen that sort of be curtailed a bit in recent times. Can you talk to, and maybe starting with Arvid, probably to start with, can you talk to the financing environment, what you're seeing in terms of banks and availability of funding, the bond market, both the cost and that availability would be great.
Absolutely. I think all through the past couple of years, when we have seen trickier working environment, we have continuously felt that bank financing has been available. As the bond market got extremely expensive, we during a couple of years did not issue any bonds, and the bonds maturing we repaid, basically replacing it with existing bank facilities. Bank facilities got more expensive, and just to give you some rough numbers, I think at the end of 2021, we would probably have paid for a 3-year bank facility a margin of 125 basis points maybe, and today that would probably be 150 basis points or something, something in that order of magnitude. The bond market, however, and 2021, we would probably have issued an unsecured bond cheaper than secured bank financing, probably at like 100 basis points. That rapidly went up to well over 300 basis points as indicative pricing, where we then obviously chose not to issue any bonds. But since December, we've actually done a couple of bond issues. In December, we had a 2.25-year bond at 215 basis points. In January, we did a 2-year bond at 190. And in February, we did a small tap issue of that bond at 175. So, and we've basically felt all along that unsecured bond financing, there's a certain logic to it being slightly more expensive than secured bank financing, because the banks actually do have collateral. But given the expected interest rates cuts over the coming year, I think that the bond market will continue to improve, also not only liquidity wise, but also price wise.
And then similarly to you, Erik, probably on what you're seeing on your side, in the sort of more Eurobank market and Eurobond market. Eurobond market.
We have had an approach that we want to have access for different sources of financing, so bond financing, bank financing, local commercial paper market as well. And then all the time we have had quite high hedging ratio and quite moderate leverage, and that turned out to be quite good approach in these turmoil times what we received. And we have had no difficulties to get all the financing needed for the company. So more than half of our financing is from the bond market, but last year we made almost 1 billion euros worth of bank financing, secured bank financing. And the bank financing was more available, it was cheaper, and of course it was secured. And now we've seen that the bank financing for us has been available, but banks have been very, very selective. So it hasn't been only a question of pricing, it has been for some players question of availability as well. And the bond market, that was for real estate players pretty much closed for almost 18 months. And now it's reopening. And we think that the pricing in the bond market is not yet attractive, it's moving in the right direction, but the swaps are still elevated compared to what's available in the bank market, and spreads are still quite wide compared to margins in bank financing. But we are expecting to return to the bond market as the market conditions improved, and now we are moving into right direction. What comes to bank financing, there are a couple interesting phenomena there. One is that banks are now providing only secured financing, but at the same time they say that companies should return to the bond market, which is unsecured. So as much, if you increase the portion on secured finance, it makes it more difficult to return to the bond market. So that's one thing. Other thing is that banks are saying that they are selective because they are afraid that if they provide financing to all players, that will have a negative impact for values. But when they are more selective, they actually what the outcome is that the values comes down. So they are not that logic, I think, the banks in all respect. But one thing is that there are differences if you compare bank financing and bond financing. Taking the nature of real estate business, longer maturities makes a lot of sense. And today, and that has been the case actually many years, longer maturities has been available only in bond market. And bank finance is 3 years or even shorter than that. And that's not the best solution for real estate business. So we think that it's improving. I mean, bank financing is improving and the bond financing is improving. Our aim is to return to the bank financing, but this has been very important to have access for different sources of financing, so you can decide which route you go in a certain period of time, and then it's very, very important for companies to take care that they keep their key figures in a way that they do have capacity to return to the bond market. I mean, not to take the secured financing portion too high and so on and so forth. But things are improving, and especially starting beginning of this year, the bond market has moved into right direction, and Citycon's example is a good example in a way that it's not only logistic companies, not single A-rated company, but there are other real estate companies that seems to be now have the opportunity to tap the bond market.
Well, thank you. And on that, just a very quick answer, because we could delve into the technicalities of it. Do you see a risk to bank financing, in commercial real estate from Basel IV being rolled out, which seems to impact on banks' ability to lend against commercial real estate? I just wondered if that's something you consider to be a risk, or you don't see that as being a major issue. Start with you, Erik, quickly. Hopefully, relatively clear. I appreciate it's quite a technical subject, but
so short answer is no.
Okay.
So based on discussions with the bank, they are not that afraid of the impact of Basel IV. But of course, it might slightly limit the capacity in total for real estate lending, but not in the big picture.
Okay, and Arvid, similar.
I would agree. That I mean, banks will probably use it as an argument in the negotiation.
Exactly.
but I don't think it's going to change the big picture.
Cool. Probably focuses bank funding on even more so on the right partners, as we've sort of seen over the last 12-18 months.
Exactly.
And Jani, you raised an interesting point earlier, which linked to this as well, around the focus on LTV. And I think that's been, should we say, either the key measure or the sole focus of both investors and banks and companies in the real estate market for the last, should we say, 15 years, if not longer. And there was a reduction in focus or a reduced focus on more cash flow measures. And I just wondered if, moving forwards, you think that LTV becomes less of a factor and things like net debt, EBITDA or ICR become more of a factor? Maybe starting with Arvid on that one, or Ulrika as well.
As I think I said during the presentation also, I think it's to evaluate the financial stability of a real estate company, you have to look at the cash flow. And the LTV, I mean, since the value of a property is not possible to establish scientifically, there's always going to be a variation or an uncertainty as to what the value actually is. And because of that, and I think the past couple of years have also shown that when things get a bit stressed, what you need to look at is the cash flow and some sort of metric capturing the cash flow.
Similarly, Erik, I imagine you'll have a similar view to Jani on this one. It'd be interesting if you don't.
Yeah, it's good to keep in mind though that for example in rating agents matrix there are several figures and they put the weight on your position, your brand name, and quality of your property, so on and so forth. And then there are some key figures, and what we've seen already in last 12 months or so, they are moving more towards cash flow parameters from loan to value. Loan to value will not disappear, but they are putting more weight on whether it's fixed charge coverage or ICR, but definitely this type or net debt EBITDA, definitely this type of matrix are going forward more important.
Do you think that increased focus on rent, and it's sort of an old-fashioned term almost, rent and cash flow within real estate, which was the key focus prior to probably the pre and post GFC cycles that we saw, do you think that increased focus to something that actually becomes a positive for long-standing traditional real estate companies who maybe got a bit priced out of the market by what we term spreadsheet investors who are kind of using the market as a financial instrument? Maybe Ulrika and I would start with you on this one. Just your sort of views there as to how the market changed, shall we say, in terms of the investor base, and how maybe that goes back to a more traditional investment opportunity or investment market.
If I start, I think you have a good point. We can feel or could feel over the past years, pre the increase in interest rate that we've seen, that external parties viewed Wihlborgs as a company as pretty cautious, stable, but a bit dull. and I think well, the change in interest rate environment has shown that I mean you really need to focus on the core operations. I mean we don't view our properties as financial investments. We view them as operational assets which we need to operate in the best possible way. And that we believe is the way over time to make money in the real estate sector. But of course, looking at over a decade of falling interest rates and interest rates at zero, it of course is it attracts many people who well, as you phrase it, only use the spreadsheet and see what they can make out of different asset allocations, so to speak. And then so that's my view on that one.
And actually, I think that we have some histories from this time, both, of course, when we tried to explain why we thought that stability and a good cash flow over time was an important factor, and why it was actually cool to have a stability. And then that changed very rapidly. So we got questions on how we dared to continue with our investments, for example. And we also see examples of we have bought some assets from other companies that maybe saw these assets more of a economical investment and had no interest on the actually property and keeping the information on the property, for example. And that, maybe it's not fair to say that, but I don't count that.
I think it's fair.
Property companies. I count that as something else, actually.
Yeah.
And maybe that is more reasonable today to see for many people. That is a great difference between companies and what we're here to do and how we see on our daily operations.
And Jani, did you want to add anything on a similar thing in terms of that focus point?
Yeah, I think if you start looking for companies, whether they are a holding company or operational company, this brings back the question of being an operational company and being good at your core business, so operational excellency. Then I think it's an interesting question that what's the shareholder story in the future? You have seen in the market different stories. Some traditional way is real estate paying dividends, steady cash flows. Then you've seen strong growth stories. And in some cases, a combination of those two angles. But I think this kind of buy and build on Excel sheet, grow fast, gets quite difficult. You have to have the core operation really solid.
I think that's very fair. I mean, the interesting is then it comes to sort of the highlighting around the transaction market and expecting that to improve through this year. And there's a lot of sort of commentators, I think, highlighting that, none more so than the brokers who are struggling to get paid, I think, hoping that transaction market improves. What makes you think that will do so? And I think another sort of linked factor is if there is the opportunity and if the transaction market is improving, that's most likely because there is a good forward look return on those assets. Will the listed companies, do you think listed companies, and including yourselves and more broadly, if you wanted to comment, will start to take advantage of that? Because arguably the only way to do that, if funding is not as attractive from the debt markets or not as readily available, will be through equity issuance. Is that something that you're considering as a way to grow into those attractive opportunities? Maybe starting with you, Jani, on the Kojamo side.
Yeah, I would say that the first starting point was the decision we made a year ago that let's keep the company strong. So if you're strong enough, then you can think about opportunities. Don't get into defensive battle and a negative circle. There will be opportunities. I would say that why rush? Opportunities will be available for some time. But then you have to have a plan. What's a opportunity you really prefer, and with what parameters and when you do it? But now there have been really limited number of transactions, only a couple of properties sold in the market, so not that much. Of course, in a way, a lot of so-called opportunities if you look at the balance sheet of the construction company, but as those are typically built to sell projects and they have already sold some of the apartments, and we typically like to buy the whole building, so we don't prefer buying separate apartments from different buildings, but opportunities will come, and then it's a timing question. As said, the parameters will settle. and sometimes you get an attractive enough opportunity to move fast. Like actually, when COVID-19 kicked in and construction companies started to struggle, we did a couple of quite appealing agreements, which included, for example, Lumo 1 high-rise building here in city center Helsinki.
Mm-hmm. And do you see a similar thing, Ulrika and Arvid, on that opportunity and the opportunities coming? And would you be willing to take advantage of those opportunities using, say, equity funding to sort of pursue those ambitions?
I would say that not today.
Okay.
Why not maybe later this year or 2025? Opportunities will be available. Then equity is one option. I like to think like the same manner as Erik talked about our financing. It's good to have many tools in your toolkit. So then you have options, and equity is one option.
And similarly,
it's like we discussed the LTV question. Is whether you balance more the L or the B. You could.
If I start out from the Wihlborgs perspective, I think first we have actually managed to grow since 2005, irrespective of if you measure property value or rental income or operating surplus. We've had a compound annual growth rate of over 10% per year without taking in any new equity. And we do take a certain pride in that, actually. At the same time, we have, although we've been an acquirer during these years, we've been able to acquire things without taking in new equity. And we've been, I would claim, selective in our acquisitions. We haven't gone for the extreme growth, buying at any price during the past few years, and it's not likely that we're going to do that in the future either. At the same time, we have the financial strength to be able to look at acquisition opportunities. We're probably even a bit more picky on the right location, the right quality of the asset, the right price, of course. And as I think I know you know, Paul, we have during all these years at every AGM we ask for a mandate to issue up to 10% of the outstanding shares in order to create a flexibility or have another tool in the toolbox if a sizable acquisition opportunity would come up. We've so far never used it, but for the AGM in April this year, we will ask for the same mandate from the AGM, and then we'll see what happens.
Yeah,
and I would say that we have the obligation to always look into opportunities, but also, as you mentioned, Jani, to be true to your core and to have the stability as a strength and your base when you are able to look at things. That's the first thing to be aware of course, but it's only if we every day ask us if the strategy we have is the right one, that we can keep up and do the changes we need all along. So even if we haven't used the opportunity, every day we have to see, is this the day when we should use this opportunity? I think that's the answer to that one.
Yeah, I would say that have to agree, and I started thinking that basically we started investing 2012 when I joined the company. I think close to 5 billion already without asking once for equity. And we have the opportunity as well, but looking forward, it's good to have the option in the toolkit. You might benefit from using it.
I think, I mean, as we've sort of said throughout, the last, shall we say, 13, 14 years have been a very different prospect to maybe what the next 14 years will be in terms of that cap rates and asset valuation that's been created, which has enabled a lot of that investment and that expansion. The question is, will that be the same moving forwards? And I think, as you've said all along, that different focus on cash flows, that different focus on financing structures, maybe will require a different financing environment or a different financing structure and capital stack moving forwards for the sector. Just sort of continuing on, you mentioned a few times around the sticking to your core markets as being a key differentiator, probably relative to some of the others who have expanded into new markets to create maybe those opportunities or to access different financing. Maybe coming back to Ulrika, because you mentioned it a few times, the cluster model that you have and the core sort of focus that you have within the Øresund region, how much of a differentiator do you think that does create from your ability to, should we say, pick the right assets, find the right opportunities, generate the better rental growth on your assets? Is that something you think that does set you apart and will continue to do so?
I mean, of course, you can take the you can make the assumption that, for example, stability, you make great stability by being all over the place in different markets and with different kind of businesses, and that could be a part of it. We have more decided that we believe if you are in one market and you know that market better than anyone else, you can take care of the opportunities there better than anyone else. And yes, we think that we have proven that works, and we have been proving that for a quite long time. But of course, you can do in different ways. And as I said, every day we have to ask ourselves if our strategy is the right also for the future. I think maybe a year ago, when we were at some kind of investor meeting, a guy came in the room and he said to us, "Okay, it's easy for you guys. You just continue doing the same thing and continue to deliver." And I thought to myself, okay, here we are missing something, because I think it's only because we change every day that we can continue to deliver. Because everything around us change every day, and it's only if we change in the same tempo that we can continue to deliver. But sometimes it's difficult to also explain that to yourself and to your own organization, that is how we operate things. We try to change everything and every day and try to do things a bit better. And also ask ourselves, is this the right market? Should we do more here? Should we do anything else? Should we go anywhere else? And improve things all along. So, of course, you have to be aware of that you can do things in different way, but we have chosen this take that to ask from ourselves that we should know this market better than anyone else, and therefore we can create more opportunities there.
I know you're seeing just on that, because to an extent you're a slight victim of your own success, that as you operated the market well, it drew more investors to your market. Do you think that moving forwards, given the change in that financing environment, and are you seeing this in terms of when you're going for acquisitions, there is now less competition for acquiring assets, for investing, and actually that doesn't necessarily make it easier, but maybe gives you more opportunity to generate good returns on those investments? Is that something you're seeing or expect to see?
First of all, competition is good. Competition is good because that develops everything. It creates and demands, set up high demands also for ourselves. And we have seen good competitors coming to this market, investing. Maybe they have even been better than us to increase the rent levels, for example. Better of telling the story about their new blocks and such things. So we have, it's a good thing with more investors in the same market, that creates attractiveness as long as you can learn from that and do even better. And also, of course, we are evaluated on the base that we have chosen to be on this market. So if no one else want to go here, I think that is harder for us to explain why we think this is a good market to be at. On the transaction market, yes, we have seen during a period when there were a lot of investors coming to this market who wanted to invest, and we thought that the price levels were actually quite crazy, and ask ourselves, is it we that are slow, that we don't keep up, realizing that this is a new level? But we had a hard time realizing that, seeing that this level was actually a long-term good level to be at. So we have chosen to be more investing in our own properties, developing our own projects. We think that gives us the best quality and the best sustainability over time. And we have invested more in products and assessment. That way we can add on our technical skill and improve things, and therefore raise the level on the assessment that we buy. So I don't think that we will be the best buyer of already full development areas. And that might be wrong, of course, that we think that we can do it even better on ourselves. But that's the way we have chosen to do.
And similarly, Jani, in terms of your focus on obviously the residential, which is a much more operational marketplace, and sort of concentration on the Helsinki market in particular, do you see that continuing, or do you see opportunities to move into other new areas, or do you think it is the differentiator for you?
I would say that, as mentioned just there, I do understand companies going to different countries in order to stabilize the business or diversifying the risk, so to say. We've been around for 55 years here in Finland, and even not for 100 years like some of the players, but we like to think that we know the market and we know the players, we know the micro locations, and as long as you believe that you are really able to grow in your core area, the place you know the best, why don't you grow there? And as I mentioned, we still have quite valid mega trends creating long-term demand. Helsinki region is a capital here in Finland and will be the winner in urbanization game. Most of the new jobs are created here. So the city area of Helsinki needs apartments as well, Turku and Tampere. But of course, on the other hand, it's something that you will have to follow in the long run. Is there enough room for you to grow here in Finland? And if you feel that you're not able to grow enough, then you should start scanning other markets. And most likely, the easiest way would be to find quite a similar market or similar country to your own, not starting from totally something different. But I would say that I was asked that question 5 years ago, and we decided that the strategy is to stay here in Finland. And even though we had a lot of competition from international players in acquisitions, we were able to grow, invest between 400 to 500 million euros per year with a net initial yield of 4 or above 4. And I was not ready to change that with a net initial yield of 2 and going to Germany or Sweden. And I'm quite happy today we did not do that.
I think since we are active in 2 different countries, may I just chip in that although Copenhagen and Malmö are very close geographically, it's 2 different markets. different legal frameworks, different business culture, etc. So, I mean, going to another country, it is actually a rather big step. And we've been active in Copenhagen since, is it 1995 or 96? So we've been able to build some experience also there. But we have a Danish team managing the Danish operations, because I mean we would never be successful there trying to manage that by Swedes based in Malmö.
Yeah. No, I think it's a very valid point. And in terms of property as a local market and having local knowledge is a huge advantage. And do you just sort of link to that, see any risk that limits the, should we say, expansion capabilities, the size of your businesses? Obviously, something we come up against is, say, global investors looking at real estate investment do struggle quite a bit with Europe at the moment, just because the companies are not generally very big, not the most liquid. Do you see any issues with that? Do you see any opportunities of increasing scale to improve that? Or is it not something that you're focused on in terms of getting that international investor base coming to your stock? Maybe starting with you, Jani, and just get your thoughts on that.
I said something that we have to follow, and if you would go abroad, you need a big enough scale from the day one. Why go with 1 or 2 or 5 properties to learn a different market? Because you need the local organization. Then in the big picture, I find it intriguing, the question that who should be diversifying? So is it the company or the investor? So if you have local players who are extremely focused and efficient, the investor can choose players from different countries. So do you need to diversify by investing in a company who diversifies? It's a tricky question in my eyes. But I would say never say never. But at time being, we find enough growth opportunities here in Finland and a lot of long-term demand.
Yeah. No, I think that's the point. Is there enough to create a sizable organization that appeals to global investors from a share liquidity point of view? I think I agree on that. That focus is a core advantage that both companies have, and it's just, is there enough opportunity? And maybe Ulrika, just getting your thoughts on that as well.
I would say that in our market, yes, as long as we see a positive and increasement in the businesses overall in the western part of the Skåne region and in the Copenhagen area, and a positive inflow of new inhabitants here. And so yes, that's a good possibility for further growth also for us here. I would rather say that if you haven't got the amount of underlying growth that you need for expansion in your own company in real estate business, of course you can go to other geographical markets, but you can also add on other products. It's not so many years ago, Wihlborgs also had housing as a part of our operation. And today we have decided to be more focused on the workplace and be really efficient on that part. But you can expand the business both by adding on geographical positions, of course, but also other kind of products in the geography you're already in. So you can do that in different way.
Yeah, I take your point, Paul, that of course the liquidity in the stock is of course important for large investors. I would claim that it's of course less important if you're a long-term owner. So if you buy and hold, that's going to work anyway. But our reasoning is really that we have a much stronger focus on actually trying to be the best at what we do rather than being the largest.
I think that's very fair. Just, I suppose, a final one in the last few minutes, and then we've got a sort of a one-word answer right at the end. The penultimate question, should we say, is there's a lot of commentary at the moment around valuations of assets, and as you mentioned, the valuation is not a scientific thing. There's lots of debate that can happen on that. I think a lot of companies, or a number of companies, have mentioned, yields are back to 2017 levels as being some sort of factor that we've moved enough. But if you look at the financing environment, is obviously still significantly higher than it was in 2017, and the cost of capital, if you take the 5-year swap as a sort of proxy, we're more back to 2010-11 levels when yields were significantly higher for real estate assets. Do you think that they have moved enough, or would you expect further movement in the yield on the assets, maybe partly compensated by rental growth expected to come through? Maybe starting with Arvid and Ulrika on this one.
Right. Given the changed sentiment regarding the interest rate environment, I'm not sure that yield requirements in property valuations are going to continue upwards. But I think it's also important to bear in mind, and I don't remember correctly maybe, but I think Kojamo, you showed that as a slide where the valuation change comes from. We had our external appraiser also look at if we were to apply the current yield requirements in the valuations on the operational surplus generated. Sorry, I'm getting mixed up here. Using today's yield requirements on the previous year's operational surplus, our valuations would have gone down by 12.5%. But we've improved our operating surplus by increasing rents, reducing vacancies, investing, etc., etc. So all in all, we're down approximately 1.5%. And I think that is very much worthwhile keeping in mind that you have different factors working in different ways in the total valuation.
And we talk a lot about what we call running yield, not valuation yield, but running yield, what the portfolio actually perform. And we're back to running yield at the same level as we had 2015, 5.8 as a total. But I would also claim that the quality of our portfolio is much higher today. So during this period, we have, as Arvid said, we have invested, of course, and we have improved things, and we have sold some things that we don't think is the right kind of properties for us. So we have also improved our portfolio today.
And I suppose to ask a slightly different way, if an equivalent portfolio as yours came to the market at the same valuations, would you acquire it today?
That is unlikely to happen.
A little bit of an unfair question, but
yes. No, I don't know. It's very, very hypothetical. But I think when we look at acquisition opportunities, we very much think about how can we do something better with this asset than the previous owner. So whether it's a small acquisition or a large acquisition, we would look for ways that we can actually make this asset perform better, because that is the way we feel that we can create value.
For example, we bought the Österport here in Malmö a few years ago. We sent our technical skilled Ivan there, and he just adjusted things, and we have decreased energy use with 35%. So there's things we can do, and that's just a start for that building.
Good old-fashioned real estate knowledge, shall we say, in terms of driving better performance. And Jani, similar question for you in the last couple of minutes, just around that valuation and how you see things evolving. over the coming periods?
Yeah, we'll start by saying that you typically hear people comparing yields, and that's a tricky one because somebody has a net initial yield, somebody crossing, someone has running yield, and several different yields. And at the end of the day, yield is only one parameter. Nobody seems to be talking about who's capitalizing repairs or maintenance, what's the net rental income, what are the other parameters concerning operating expenses. So it's a more complex question than just saying that the yield is 4.4. So
I think it's
but
a very valid
valuation
point,
should be valuations should be based on actual data from the market. And that's been the challenge now for a certain period of time. And looking forward, most likely this year it still is the question. If nothing is changing, the values should not be changing. That's my opinion. And now the estimate is that interest rates would be coming down looking forward. So that decreases the pressure from valuation rather than brings pressure to increase the yield requirements, because that was the case the valuation expert presented when they started providing pressure on the yield requirement, that in the operational environment the interest levels have been increased, so the valuation has to adapt. But I have to say that, as you said, that where you should compare it, but one thing is for sure, the yield cap has not been fixed. It's been changing, and it was extremely large, even though the valuation yields were low. So there was room to squeeze.
Yep. No, I think it's a very valid point, and I think we're just coming to the end of the time. So I just wanted to say thank you very much to all the participants. I think it's been an interesting conversation. If anybody would like to get in contact with any of the participants to hear more, or would like to get in contact with me to hear more from me, but probably not, then do please get in touch and we can pass on all the details. But thank you again to everyone who's participated and sending some questions. I think it's been a great discussion. So thank you very much.
Thank you.
Thank you.
Thank you. Bye.
Bye.